ecosystem, and that also is a gating factor in terms of how many airplanes both Boeing and Airbus can ultimately produce.
Now, look, it's been a couple of weeks since Boeing announced Calhoun was going to go at the end of the year. This is a company essentially in strategic limbo. And I just want to get a sense of to what extent that holds this company back from delivering on the requirements of the FAA and then getting back to some kind of uplifted quality norm.
I don't think it's helpful to have this period of limbo, to your point, but I also think that they don't have the right candidate yet signed up to replace Calhoun. So on the one hand, you would want them to find that person, and introducing another figure right now is just going to add to the uncertainty. So I do think, Boeing has every reason, and I think they are finally taking this seriously, to get to the bottom of their quality control issues and make sure that they can reassure their customers that they can actually deliver the planes that they have promised. And so I think they have every incentive to figure this out, no matter who is in the CEO role. But there is, they do need to take the time to get this right. They need somebody in that job who is going to actually solve the problems, because Calhoun was brought in to solve a crisis when the two 737 MAX jets had crashed, and Boeing is still dealing with many of the same problems. And so I think if you're an investor or a Boeing customer, you want them to really take the time to find the right person to lead this company into the future.
Brooke, thank you very much. That's Brooke Sutherland. We'll wait for those numbers from Boeing. We'll bring those to you as soon as they cross the Bloomberg terminal. Sector price action for you this morning. Abby's with me.
Well, Manus, we're looking at a very small gain for the S&P 500 right now, up about 0.1%. Now, interestingly, it is a broad-based gain, lots of sectors higher, but not up by much, and that is basically why it's such a small gain. Up top, real estate up 0.5%, despite the fact that you have yields down, which would typically, actually that does make sense in terms of dividends of real estate looking more attractive, plus yesterday's big deal, $10 billion deal, Blackstone buying that apartment REIT. To the downside, financials, industrials, consumer staples. Now, what's interesting, though, we may have financials down 0.3% ahead of the big banks reporting on Friday, Menace. However, or some of the big banks, I should say, the regional banking index, that ETF, and in this case, index, up 1.8% over the last 2 days. So some of those small cap banks getting a bit of a bid.
Okay, Abby, thank you very much. Coming up in the show, market moving events to set your watch by. It is your trading diary on Bloomberg. basis points down on bonds really enough to give succor to the equity market? Well, if that's a narrative you want to play out, please do. You've got stocks holding on to their gains. This is ahead of the CPI. We're expecting 0.3% of a number on the core. We've got 24 hours to run, less than 24 hours to run on that. Right now, there's a resilience in stocks. Your trading diary looks a little bit like this. Treasury auction is coming. $58 billion of 3-year notes at 1 p.m. Eastern. Wednesday, it's another big day for CPI. The report in America, as I say, will come out. And you have PPI and initial jobless claims hitting the tape on Thursday. Follow through, you'll have an ECB decision, and that differential between the ECB and the Fed is going to become ever more apparent. Mohamed El-Erian's discussion on surveillance this morning is relevant on that. Bank earnings hit the tape on Friday. JP Morgan, Wells Fargo and Citi all deliver their results. So we're counting down to these auctions at the short end and indeed longer dated paper as we go through on the week. Threes today, $39 billion of 10s tomorrow, and $22 billion of 30-year paper coming through on Thursday. That was countdown to the open. We're nervous ahead of CPI. This is Bloomberg.
All right, we are 30 minutes into the U.S. trading day on this Tuesday, April 9th. Here are the top stories we're following. State Street versus everyone else, with the firm's chief investment officer sticking to a call for a half-point Fed cut in June as the rest of Wall Street dials back their bets. EVs in focus, with Tesla's first CEO, Martin Eberhard, saying it would be a shame for the EV maker to backtrack from its plans for a cheaper car. We'll discuss the global competitive EV landscape and increasing exposure to alternatives. a conversation with Kristen Olson, global head of the Alternative Capital Markets Group for Goldman Sachs, about why ultra-wealthy investors are still underweight. She joins in our Wall Street Week Daily segment. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. And you take a look at markets on this Tuesday. We do have some green on the screen. Another quiet day, but the S&P 500 currently higher by about 0.1%. I did say it was quiet. You take a look at big tech behind me. The Nasdaq 100 currently up about 0.2%, 0.3% even. And then you take a look at small caps, not exactly leading, but not the laggard either. The Russell 2000 currently up by about 0.2%. But in some ways, it really feels like the trading week starts tomorrow with March's CPI reading. Joining us for more is Bloomberg's Mike McKee. And Mike, how consequential are these figures tomorrow at 8:30 a.m.?
Well, they're going to have a lot of impact, particularly in the markets. The Fed's got till May 1st, but this is the last CPI they'll get before that meeting, so it will definitely figure into their thinking. It could make the case that Lori Heinel and the folks at State Street are trying to make, that the economy is weaker than thought. They're not going to cut 50 basis points unless we get a big drop in inflation, and inflation is expected to drop, but only a little bit. The headline and core both forecast to drop by 0.1 percentage point to 0.3 for the month, which sends the core down on a year-over-year basis. But the headline, driven a little bit by base effects, a little bit by energy, is supposed to rise. And that's not going to be something that would give the Fed permission to move. The one thing we're going to be watching within that, a couple things we're going to be watching. Obviously, we'll be watching used cars, because we always do, and we'll be watching housing. But goods versus services, and that's been a disinflationary impulse. Goods prices have been falling for a while, but if you notice last month, they rose a little bit. Does that continue? That could drive one way or the other what we get out of CPI, because services, we know, is still elevated, still going somewhere. And if we got a rise in goods prices, that too would worry the Fed. One other thing, though, that we did get today, Katie, that might influence the Fed to a certain extent, but certainly influence the folks at State Street, is the Small Business Optimism Index from the National Federation of Independent Business. It drops to 88.5. That compares to average in 2023 of 90.7. So small businesses getting a little more pessimistic about the way the economy is going, even if most of the other data isn't showing it yet.
And you brought up exactly what I've been thinking about, and that is the big call of the day, that call from State Street, of course, a potential half-point cut in June. Just quickly, Mike, tell us how out of consensus that is at this juncture.
Well, they're the only ones I know that are predicting a half-point cut. There's about a 50-50 split by most economists on Wall Street of whether they go in June or July. And, of course, this changes on a daily basis as the data comes in, back and forth between June, July, and occasionally September. But nobody's calling for 50 basis points at once. And it really pushes back against what Fed officials have said, that they're going to take this very slowly. So it would take a lot to get a 50 basis point cut, a big collapse in the economic numbers.
All right, Bloomberg's Mike McKee. I'm sure we'll be talking to you in 24 hours' time. We'll see you then. Let's continue this conversation and bring it to the markets. We're going to do that with Kuei Nguyen. She is Research Affiliates CIO, joining me on set now. It's great to see you.
Nice to see you, too.
So it feels like we have two ends of the spectrum here when it comes to Fed calls. You have State Street, of course, calling for that half-point cut in June. And then you have the likes of Torsten Slok from Apollo saying, actually, the Fed isn't going to cut at all this year. Between those two extremes, where do you fall?
I think we're still seeing likelihood of a couple of rate cuts this year. I think 50 basis points at once is really aggressive. But certainly what we're seeing is that the economy, while it's solid, is not necessarily speeding up. Marginal signs, the Small Business Sentiment Survey is one of them, that shows that even though growth is okay, it's fine, that the rate of change is slowing a bit. So I think that's one of the reasons you're actually getting a lot of a lot of discordant messages from the Fed. Some people saying we're not in a hurry. Others are saying 3 cuts are still on the table. I don't think the Fed itself knows exactly what's going to happen, but likelihood is there will be cuts this year.
And I'm glad you two brought up that U.S. small business optimism reading falling to an 11-year low. Definitely feels a little out of step with the data on the ground. But let's be pragmatic here and talk about how much it matters for the equity market, those two extremes. What's the difference between 3 cuts versus no cuts this year for the equity market's performance?
So the main difference is not necessarily in in small caps per se, but really in these really big growth companies and the valuations that are attached to that. And so no cuts, I think, really starts to put pressure on the valuations of companies where cash flow is not particularly robust or valuations are really, really stretched. And so in that case, what we favor is we favor relatively undervalued companies with strong balance sheets. So that's really been our approach last year. It continues to be our approach this year. And I think that if you were to look in that space, there's lots of interesting stocks to be had.
Well, broad brushstrokes, where are you most finding those undervalued names? Because, if you take a look at the sector performance year to date, a really rough guide here. I see energy up at the top. We haven't seen that in a while. You also see financials and industrials punching above their recent weight. What sort of sectors and industries are you finding those opportunities?
Certainly last year was a lot different, right? Last year we saw a lot of opportunity in technology. This year, I think we're seeing a little bit more opportunity in financials. Wells Fargo, I think, is a great name. Very solid balance sheet. Great business, and they're doing particularly well. Also, I think one of the things that we are looking at is industrials. I think 3M is a very interesting company. Very, very inexpensive. They still have a bit of a business moat, a lot of expenditures on research. They have a new CEO, which is particularly exciting.
Yeah, and of course, Wells Fargo is taking the earnings stage later on this week on Friday, along with JP Morgan and Citi. But actually, a conversation I was having a couple of weeks ago with Rob Arnott, of course, of Research Affiliates was, okay, there's a lot of undervalued companies in the market right now, but how do you go about identifying and then avoiding the value traps?
Well, for us, I think there are really 2 ways of looking at value traps. The first is really quality. So if you look at metrics like distress, you really want to avoid the cheap for a reason kinds of companies. And then the other thing we look at is we look at capital discipline. Is this a company that returns capital to investors? This is a company that makes investments wisely. And what is the return on capital for what they invest? And so once you basically eliminate the ones that are the detritus on those metrics, you end up with some inexpensive companies with very acceptable quality metrics. We also take a look at recent momentum. You could have value companies are hated by the markets. That's why they're cheap, right? So what you want to look at is you want to look at companies that aren't being just sold off dramatically by the markets that have this massive headwind in their face. And those are the ones where if you buy them, they can eventually shine.
And so for those inexpensive companies that aren't necessarily value traps, that aren't cheap for a reason there, other than just the market has kind of been ignoring them, what is the typical catalyst that you need to see for sort of that market attention, that focus to come back to some of those names?
What we've seen is sometimes the narrative around them changes, right? So, a great example last year was Micron. Micron was a company in the memory chip space. There's a big amount of oversupply, big glut, trade war with China, all of these negative headwinds. But the reality is that Micron is a company with a very, very solid base. People need their products. People need their chips. And so as time went on, one of the things that we saw is that the market started to realize, supply is just supply. Eventually supply will get worked through. Everybody needs these chips. It's not like we're going back to the Stone Ages where we don't have chips in any of our products. We have chips in everything now. So this is a very, very secular growth area.
Well, Clay, we are just getting started. Sit tight for a couple minutes. We're going to take a quick look at what's moving now underneath the markets with Bloomberg's Emily Grafeo. And Emily, starting with a blast from the past.
Yeah, well, BlackBerry, you might know it as a company that produced those smartphones before the iPhone and Android completely took over the market. But a few years ago, they pivoted to focusing entirely on cybersecurity. And now just today, they announced that they're going to be doing a robotics partnership with AMD. That stock is up now over almost 10% over the last 2 days, still down about 13% year to date. But they said the collaboration is focused on the robotics industry to provide real-time performance, precision, reliability, and scalability. And again, with AMD. So a major partnership there for a blast from the past, like you said.
Yeah, I had a BlackBerry all the way back in high school, which was kind of long ago. But clearly, you can see that traders are cheering on that pivot. Let's talk about Tilray, though, because Tilray not exactly having a great day.
Yeah, that stock is down about 17% right now, and their earnings just all around have missed estimates. The cannabis company reported a loss per share of 12 cents. That was worse than estimates of a loss of about 5.5 cents per share. The revenue for the third quarter also missed, coming in at 188 million versus estimates of 198 million. And you can see that stock down over 19% over the last 2 days. And it really has not been able to go anywhere close to the highs that it made back in 2018. It made a high of about $148 per share. Now it's closer to around $2 per share. When you look at the earnings report, the forward guidance that they issued also really came in below estimates. The company said that they can no longer predict that they're going to be able to produce positive adjusted free cash flow, and then also their revenue estimates for the full year, that fiscal year for 2024 also came in below estimates. So overall for Tilray and for a lot of those other cannabis companies, it's been really hard to kind of see those stock gains after the bull market of a lot of these companies back in 2018, 2019.
Absolutely, and you see that in the 19%, the worst day since May 2023. But let's finish on another blast from the past. American Eagle, what's going on?
That's right. Maybe you wore some American Eagle.
On my BlackBerry, yeah.
Right, with your American Eagle jeans. This is another blast from the past, but JP Morgan raised their guidance on, or their rating on this company to an overweight. Analyst Matthew Boss also raised his price target on the clothing company to $31 a share. He said that during the retail conference last week that the firm held, the company seemed to express a conservatism. The analyst also sees revenue accelerating for American Eagle as they recapture market share in women's tops, activewear, and premium denim. So maybe more people are going to go out and get some jeans from American Eagle. That's at least according to JP Morgan. But again, that stock pairing some earlier gains from this morning, but still in positive territory today.
Absolutely. It's been on fire this year, up 16% year to date, and that's after it rallied about 51% last year. So clearly a lot of people buying those jeans. Bloomberg's Emily Grafeo, thank you so much. Now coming up, Tesla's first CEO says it's a shame if the automaker scraps plans to build its low-end car. More on his comments next. This is Bloomberg.
season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
I read recently that Tesla has decided not to pursue their Model 2, the low-end car, because they don't think that they can compete with the low-end Chinese cars. I think it's a shame. They might want to rethink that. It's a new technology, and it's difficult to drive the technology price down. Tesla needs to be focused on cost. Tesla needs to be focused on cost instead of focusing on technology for the sake of technology.
And that, of course, was Martin Eberhard. He is the first Tesla CEO speaking to Bloomberg Television at the HSBC Global Investment Summit in Hong Kong. Now, it was reported last week that Tesla could scrap plans for its low-cost Model 2 vehicle. CEO Elon Musk denied the report. For more, let's bring in Bloomberg's Craig Trudell. And Craig, what's the latest on what's actually happening with that Model 2?
No, I was hoping we would hear from Elon Musk about this yesterday. He went on a podcast interview with the head of the Norwegian pension fund. Curiously, wasn't asked about it at all. I was shocked that ended without any discussion. They did have quite a few interruptions with X Spaces going out yesterday, but the short answer is we don't know what's going on here. We know that this is a next generation vehicle platform that is going to share or sort of underpin both a planned robo-taxi and a lower cost vehicle, the Model 2, as Eberhard put it. And so perhaps there is some sort of room for, if Tesla is feeling really good about its ability to deliver self-driving, to prioritize the robo-taxi over the cheaper car. I think a lot of folks who have been following autonomy are very skeptical of this idea that Tesla has a sort of breakthrough up its sleeve, in the sense that this is a problem that's going to take decades to solve, as opposed to months or even years.
Absolutely. Take a look at some of the sell-side research notes out on the heels of that announcement. A lot of skepticism there. Bloomberg's Craig Trudell, thank you so much for that update. And let's broaden back out to these markets, because still with us we have Kuei Nguyen. She is Research Affiliates CIO. So we were talking a little bit before the break about Micron, of course, one of those AI names that isn't NVIDIA. Talk to us more about the space in AI outside of NVIDIA, because it feels like more and more that's where the eyeballs are going.
Sure. I think that people are beginning to realize that AI isn't just about the NVIDIA chips. You're going to need a lot of different things to support that. Memory is one of them. The other thing is that you're going to need cloud services. You're going to need a lot of processing power and hardware as well. So when NVIDIA gets overhyped, overexpensive, people start to look for cheaper options. Micron and Lam Research in the memory space definitely benefited from that. But we're also seeing benefits to other chip companies, smaller ones this year. To me, I think this could be a multi-year cycle for many of these companies. We continue to hold these names, and they're not as cheap as they were before, but in some ways that's a good thing for us. Other ways it creates a bit of a challenge in that you have to find what the next idea is.
So not exactly value companies.
Well, they were value companies last year. I think this year I would say they are fairly valued, but many of them are very high quality, and they have great businesses.
Well, something I always wonder about, I mean, you mentioned that this could be a multi-year cycle for some of these names, is where are we on the AI investing timeline? Because it feels like it really started with the chips, of course, building out those chips that enable AI. Is that still where the best investment opportunities are, in the picks and shovels, versus maybe some of the industries that will be disrupted positively by AI?
I think it's too early to tell which industries will be disrupted positively by AI. I mean, I think what you saw in Jamie Dimon's letter just a few days ago is that there are so many different applications, and they really have to figure out which ones are the best. There's going to be a lot of experimentation, a lot of learning, a lot of changing course. I mean, in some ways, I really think this is a second inning. of AI investing. We really have no idea where this is going to go. It is going to be a big productivity enhancer for the economy in the next decade, the next 3 decades even. We just don't really know yet how.
So, point taken that this is real. It's transformational, but it's maybe too early to really pick the winners here. Is it too early to then also pick who might be a loser here?
It could be. I still go back to when I was in high school, and everybody said that with the advent of word processing, paper was going to go away. You should short paper companies. We still have so much paper. We have paper coming out of our ears. We're always buying paper, so you just never really know.
I cannot come to set without printing paper, so there's your use case there. Let's broaden out, though. Let's also talk, of course, about healthcare, because that's also a sector that you highlight. Healthcare, it's been really interesting because you have some of the companies that have been basically moonshots with GLP-1s, but then it also feels like you have a lot of those underloved names that you were perhaps talking about.
Sure. We don't really, go for kind of thematic plays. What we look for is businesses that are, very stable, they have a reason to exist, and that they're just going through a cyclical downturn, or they're being underappreciated by the market because the market's focused on something else, right? And so, Cardinal Health, I think, is a great example of that. It's a company that is focusing on growing its top line, focusing on its margins. It's got strong management, diversified business, and a very reasonable valuation. Cigna is another one of those types of companies. So very, very, basic, not really flashy types of businesses, but businesses that are, that deliver cash flow. And that cash flow had not been appreciated by the markets until recently.
All right, Kwai, unfortunately, we got to leave it there, but really enjoyed this conversation. Our thanks, of course, to Kwai Nguyen of Research Affiliates. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climbers segment up next. This is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Spirit Airlines trying to save some cash. The discount airline just announced a new cost-cutting program that will push out the delivery of new planes into the next decade. It will also furlough about 260 pilots. And of course, this news comes less than 3 months after the proposed merger with JetBlue was blocked over antitrust concerns. Next up, we have GM's self-driving ambitions trying to get back on on track. Its autonomous vehicle division called Cruise is testing robo-taxis today in Phoenix. The taxi company has been working to earn the public's confidence after one of its cars struck and dragged a pedestrian in San Francisco in October. Now, the robo-taxi business is a key part of Mary Barra's goal to double revenue by 2030. And finally, we have Pfizer seeking wider use of its RSV shot. The pharma giant will ask the FDA to extend the shot's approval to adults over 18 years old after the trials show it produced an immune response in adults who had asthma, diabetes, or chronic lung disease. Now, coming up, we are going to be talking about luxury retailers. We'll be speaking to Joe Sitt. He is Thor Equity's chairman next. This is Bloomberg. Well, Blackstone's bet in apartments is spurring a rally in the sector. Bloomberg's Abigail Doolittle joins us now with more.
Well, Katie, let's take a look at the shares of Apartment Income REIT. This is AIR Communities. This is the apartment REIT that Blackstone put a bid on yesterday. Both companies have said that it is happening, that AIR Communities will be going private. $10 billion. And you can see quite a nice pop on this, up 23%. But to your point, this really put the sector into play yesterday. A lot of these other apartment community REITs trading higher yesterday on the day. Other REITs in general, the idea that maybe this commercial real estate area that has been hit hard under fears of rising rates and that really stagnating the space along with trends shifting for how people live. So you can see over the last 2 years, it's not quite as benign. Equity Residential, another apartment REIT, down 30%. Boston Properties. This is an office REIT down 47% over the last 2 years. That's the space hit most hard with some folks working from home. And again, these demographic changes. But the deal yesterday, does it mark some sort of a bottom for the space? And the idea that Blackstone is investing for the future, that they expect rates to start falling, meaning that real estate will recover at some point over the next couple of years, wanting to be in early. And you can see here retail rates over the last 2 years really doing much better. So it's not a complete picture for commercial real estate. There's areas that have been under pressure, such as office and to some degree apartments, although it depends on the area, and then others that are doing well. One thing that we can definitely agree on, though, Katie, is the amount of debt, commercial real estate, because this is one of the pressures around the commercial real estate space, CMBS. Here is a percentage of commercial real estate debt as a percentage of bank debt. It is more than 50%. Most of this held by the smaller regional banks. Most folks, though, Katie, at this point are saying that this is not going to turn into a systemic issue, that a lot of the banks aren't going to want some of the worst properties back, that they will work it out. Some may go, but overall, it could take a long time. It could be a process, but that the commercial real estate space is in okay shape.
All right, Abigail, thank you so much. Great setup into our next guest. And we're joined now by Joe Sitt. He is Thor Equities chairman, and Thor Equities is a global leader in the real estate industry with assets in the U.S., Europe, and Latin America. And I want to start in the States because Abigail poses an interesting question. When it comes to commercial real estate, and particularly for office, do you think that we've seen the bottom?
I think that when you see some of these mile marker buyers, I call them, stepping into the market, you see Blackstone step in with first buys in retail. You know, before this, it's always been retail apocalypse, and some of the folks dipping their toes in office. It's that you're finding a floor. The private markets don't move like public markets. You don't just get stocks going up and down like that in the private marketplace. It finds sort of floor, and time takes time to filter through in the end. And a lot of it has to do with macroeconomics, inflation, and things like that start to come to pass and influence that pricing.
And I want to bring you actually a Bloomberg News scoop from yesterday about what's going on in New York City when it comes to some of these luxury retailers, such as Chanel. According to a person familiar, Chanel in discussions to buy 745 Fifth Avenue, but it's also competing against the likes of LVMH. This is, again, according to people familiar. And the fact that you see this competition among luxury retailers for some of these best buildings, these big name buildings, what signal should the rest of the market take from that?
What it is they tend to move cyclically with their stock prices and their business in terms of luxury retailers. When their stocks are beat up, business is tough, they're liquidating assets that they own to folks like Thor Equities. And then sort of when the market starts to get frothy for them, which is operating outside of the real estate world, their own personal luxury businesses are performing well, they become buyers. And a lot of it's driven by fear or paranoia that will the next boom or the next demand wave for space cause folks like that, us, to take advantage and overcharge them for rents for the best locations out there. And so they're being preemptive now. A lot of companies believe that we've got big inflation coming down the road, maybe not short term, but down the road. And they view real estate, whether it's luxury companies viewing it or anybody from any industry that's conscious of the long-term potential macro effects of inflation, trying to preempt it now and take advantage of cheap pricing. If you look at, my view, should I share my view on inflation?
Yeah.
Okay. I view a bifurcated market today in terms of inflation. Mm-hmm. You've got my view of long-term inflation, which will benefit assets, hard assets like real estate, and then my short-term view on inflation. Long-term, all that government spending that we've been doing year after year, and might happen more before the elections coming up, combined with a world that's gone deglobalization, is creating a system where the infrastructure of so many companies and systems that are long-term focused are now being at threat, risk of a big hyperinflation coming down the road. That'll benefit, yes, it'll benefit equities, real estate, gold. I think that's part of the reason why gold may be moving up, even with interest rates moving up at the same time. And so they look at real estate being a hedge. And it doesn't look like it's any time soon than that deglobalization from world conflict is going to come undone. Yes, I do think Ukraine is toast. I think that Russia has already won, and I don't think the UK probably has a stomach with doesn't have enough ammunition. France doesn't have enough troops, and I don't know that America wants to put their energy there. America, at the same time, is creating some of that world conflict that could create the inflation at the other side of the world. You look at the fact that recently America put 2,000 Green Beret troops on a Taiwanese island closer to China. It sends a message to me that, hey, this thing ain't over. And with that comes risk of inflation, which affects assets like real estate.
So a lot to dig into there, but it sounds like what you're saying is that structurally there are some long-term forces that are going to benefit real estate there. And I mean, we could keep going on that, but unfortunately, I only have about 90 seconds left with you. So I do want to get...
I'll just say this.
Yeah.
I'll just say this on inflation. I do think tomorrow's CPI report is going to short-term shock people how much it's coming down. I think that a lot of it, we got fooled by car insurance rates and things that clouded some of those numbers. And I think that that's going to create big opportunities, particularly where I am here in Europe. I think that the UK stock market is 40% discounted to its peers. Companies like an Aston Martin at 4 times EBITDA versus Ferrari at 30 times EBITDA. And then I think real estate in all asset classes here in Europe extremely undervalued based upon investors being stuck in the mud here in Europe, not being as aggressive as American investors are, looking to jump back in and take advantage of a bottoming of pricing.
So Europe cheaper than the U.S., but Joe, in the minute I have left with you, tell me about Electron, because I know you've come on Bloomberg TV, talked about it before. What is going on with that stock? It's an EV company.
First of all, we're really excited, obviously. The last time I was on your show a year ago, since then the stock price went up 400%, 4 times. And what it is the world, what's the challenge with EV cars? It all comes down to one thing, range anxiety. Am I going to run out of fuel, get stuck on a highway? And what this company's done now and really accomplished so much in the last year, they convinced Toyota and the biggest car parts company, Denso, to incorporate their technology in every single car. And you've got France, Germany, Sweden, Israel, the Autobahn, the 810 in Paris, Michigan, all putting in the technologies into their highways so that as you're driving, your car is recharging. And within the same philosophy, it'll be working soon enough if Electron gets its distribution that they're hoping to be eventually in every single driveway and every major industrial parking lot. So when you pull into a parking lot, a bunch of buses, 250 buses, everyone could be simply recharging overnight wirelessly. You pull into your driveway, it'll be recharging wirelessly. And so that's a company we believe in greatly. We found it because of the real estate aspect of our parking lots, et cetera, and finding a solution that wasn't as difficult as individual recharges. It's a business, obviously, we're excited about a year ago here on Bloomberg News, and we're as excited, if not more excited, now that the whole world has woken up to the fears of range anxiety with EV cars.
Joe, unfortunately, we have to leave it there. Have to have you back again soon for a fuller conversation. Really enjoyed this. That is Joe Sitt. He is Thor Equities Chairman. And let's zoom back out and take a look at these equity markets. We're going to do that with Abigail Doolittle.
Well, Katie, if we take a look at the S&P 500, now we're looking at a fairly decent decline, down about 0.5%. The last time I saw the index, it had been slightly higher. So a bit of a bearish tilt here. NYMEX crude oil, and of course, we have that big CPI print tomorrow. We'll be looking at a chart, so investors a little bit cautious. NYMEX crude oil down about 0.8%, perhaps acting as a drag. On the other hand, you could see oil coming in as a positive for stocks only from an inflationary standpoint since commodities have been on such a roll. Gold up 0.6%, and then the 2-year yield down about 5 basis points. So we have a risk-off day. Stocks down, bonds higher. As for the week that we're in, we are kicking off earnings, the official week. Tomorrow, of course, Delta Airlines reports, but on Friday we have some of the big banks such as JP Morgan reporting, 1.3 trillion in market cap reporting. The big week, though, will be April 22nd, nearly 20 trillion in market cap reporting, and then it always feels like we're in earnings season of some sort with some of the off-calendar reports, but you can see here that it really lessens from those 2 last weeks of April. And then finally, relative to CPI, investors expect CPI to come in for the month of March at 3.2%, which is where we are right around here. The swaps market out next year, Katie, is looking for CPI to drop to 2.5%, even below 2% on the one method. It's interesting, though, because, of course, Jamie Dimon, CEO of JP Morgan, he recently, I believe, suggested that inflation may not be over. We have had some indications of that, and that we could see rates go back up toward 8%. Never a dull day.
Never a dull day. A lot happening at 8:30 a.m. Eastern tomorrow. Bloomberg's Abigail Doolittle, thank you so much. This is Bloomberg. It's time now for our daily Wall Street Week conversation, and alternative investments are having their time in the spotlight as investors search for yield and liquidity. But how should investors be balancing the risk with potential return? Kristen Olson, she is global head of the Alternatives Capital Markets Group at Goldman Sachs, joins us now along with Wall Street Week's David Weston. And David, I think we're both really looking forward to this.
Yeah, absolutely right. As you say, they're in the spotlight. It's not like we don't notice them. So Kristen, it's great to have you here. There's a lot of talk about alternatives, and there's a lot of money flowing into alternatives. So why now should we be talking about putting even more money into alternatives, and who should talk about it?
Well, so a couple of different questions there. So I would say first, I've spent the last 25 plus years at the intersection of wealth management and alternative investments, and it's never been more interesting. And I think if you step back and you look at what's happened in the private investment world, you've gone from a decade ago having $4 trillion in private investments to now $15 trillion in 1 decade. So incredible growth. But what's really fueled that, over the past decade has been institutional allocators. Pension funds, endowments, sovereign wealth funds. But I think as you look at what's going to fuel the growth going forward, forecasts would say that of the $15 trillion in privates, about 4 of that is in individual hands today. A decade from now, that could be triple that number, right? And so I think you're seeing incredible movement into privates. And why should individuals be thinking about that? I think they're thinking for the first time about how do we add diversified returns into our portfolio, uncorrelated returns, and they're looking at the tremendous results and outperformance that investors have had over the last decade in private investments.
And when we talk about individual investors, to your point that there's still this underweight, I know it's a case-by-case basis, but is there a good rule of thumb of what sort of allocation an ultra high net worth individual should be thinking about when they're considering going into alternatives?
So, I think for us, we really focus on the ultra high net worth part of the market. And we've had for a very long time a very significant allocation to alternative investments. So our CIO, Sharmeen Mossavar-Rahmani, would advocate for almost 25% of a moderate client's portfolio be in alternative investments. Wow. Now, we've been on a long journey to get our clients there because investing in private investments is like a marriage. You're going to be in it for a very long time. And I would say we've gotten our clients maybe halfway there. But if you think about the broader individual world and you think about high net worth, mass affluent, the allocation is going to be significantly smaller because what you're really doing is trading liquidity for alpha, for return. And as you go down the wealth spectrum, you can't give up as much illiquidity. You can't give us as much liquidity. And so there the allocations are going to be smaller. But we would be significant advocates for almost a quarter of a moderate risk client's portfolio be in alternative investments.
Well, I must say that's a big number, 25% in alternatives. But you mentioned over the last 10 years the alpha, the return has been really disproportionate. But let's be fair. For a fair amount of that time, interest rates were essentially zero. So you were getting no return off of treasuries and things like that. But what about now? Is it less attractive now than it was before? Because you can get a return, off of traditional credit, bonds, and certainly the stock exchange.
Well, so I think first and foremost, we talk about this being a long-term strategy and a strategic allocation. And so, it's hard to time it and to think about, is now a good time? Should I be increasing? Should I be decreasing? Our view is you have a long-term goal and you're going to set a course and try to get to that target. And you're not going to really change with respect to market moves, interest rate moves. And then there's interesting areas that will develop as a result of what's happening in the markets. So even though interest rates, for treasuries are high today and you can get an attractive yield, if you're willing to take on illiquidity, you can get a yield that might be double that, right, as a direct lender in the corporate space. And that could be an interesting place to be today, right? So even as the broader environment changes, there continue to be very attractive alpha opportunities across the private landscape.
Across the private landscape, can we drill down a little bit here? When we think about sectors, industries, where are we seeing the most interest and the most growth, whether it be in real estate or somewhere else?
So I would say the theme over the last few years has been liquidity driven. And so one of the interesting dynamics has been that there has not been obviously a lot of capital markets activity. So you haven't had IPOs, you haven't had a lot of distributions going back to investors in privates. That's created an opportunity for investors on the other side. So if I thought about themes, secondary private equity, the opportunity and be a solution provider to big investors in private equity that need to rebalance, think pension funds, endowments, that's a very attractive opportunity. credit on the liquidity spectrum, which we just talked about, has been really interesting. The idea that you can be a senior direct lender at yields that are double digit today, very, very attractive risk return. So I think that liquidity theme has been really interesting. And I would say that extends even to private companies. So if you think about what's happened, companies today are staying private much longer than they had in the past, right? They're staying private for 10 years or more before they go public. But that means that their early investors and their employees need liquidity. And so you see transactions like, for example, Stripe, where they did a very large secondary last year. And interestingly, we were able to allow our individual investors, our private wealth clients, to get access to that secondary. So a solution for their early investors and an interesting entry point and access to a phenomenal company that's still private today.
So let's talk about the secondary market for a second, because we've heard reports, particularly in private equity, of some of the big pension plans, for example, wanting to get some distributions back. And a lot of the people haven't wanted to sell, particularly real estate, at lower valuations. How deep is that secondary market? And at some point, if it's deep enough, do you really not have to give up much liquidity in alternatives?
So it's grown tremendously. If you look at what the secondary market for private equity is today versus 25 years ago, it is significantly deeper, but it's still just scratching the surface in terms of what's allocated on the primary markets to private equity. But I think that secular trends could continue. And as more and more of the growth and investments go to the private markets, the secondary market's going to follow. And so you do see institutions using that secondary market more actively to get liquidity. And I think that will translate into private companies as well, right? Where they're realizing that maybe they don't want to be public or they want to defer that for longer. And they can because the private company is there, private capital is there to fuel their growth. And if they can ultimately solve the liquidity function, which is to get their employees liquidity after a decade, to get those early investors liquidity, and they can do that in private markets, then maybe that becomes a reason to prolong the IPO even further.
So in the same way that you're saying that, some of these ultra high wealthy individuals should increase their exposure to alternatives, it sounds like the private companies would say the same thing because they also need that capital and that liquidity.
No, 100%. And I think the other thing you're seeing is alternative asset managers are looking to tap into individual investors. And why? Because, as we said, the growth has come from the institutions over the past several decades. It's going to be tapping into the trillions of wealth in the individual market that's going to fuel the growth going forward. By the same token, individuals really need to have access to the private markets because what you're seeing is that more and more of the economy is in private hands versus public hands, right? We have almost 50% fewer public companies today than we did 2 decades ago. We have 5 times the number of private equity-backed private companies. And so as an individual investor, if you're not investing in the private markets, you're missing out on a lot of the growth in the economy and a whole lot of economic activity that you're not having exposure to by only investing in public markets.
All right. Unfortunately, we have to leave it there. Such an interesting conversation. Really glad that we could do this. That was, of course, Kristen Olson of Goldman Sachs. And David, who else do we have to look forward to?
So I'm happy to say on Friday we're going to have Bob Zellick on. He's the former Deputy Secretary of State under Jim Baker, also former USTR. He's got some strong views about why both parties are wrong about trade policy when it comes to fostering manufacturing jobs. That's going to be at 6 p.m. Eastern Time on Friday.
All right. David Weston, thank you so much. This is Bloomberg. let's take a quick look at some stocks hitting highs today. And you have Amazon and Google. Amazon, it did hit its 52-week high earlier today. You can see kind of shrinking now. It had been flirting with another record. We're going to keep an eye on that. You also have Alphabet shares managing to hold on to their gains right now, currently higher by about 0.7%, and holding on to their gains in a market that actually is taking a bit of a nosedive at the moment. You take a look at the S&P 500. I double-checked this a few times, but you take a look at where we're trading right now. We are down 0.8%, a big flip from where we were about an hour ago. It's the same thing, too, if you take a look at the NASDAQ 100, off by about 0.7% as well. And also, you look at small caps, actually the relative outperformer right now, but still down mightily as well. It's currently down about 0.4%, of course, as risk appetite appears to turn on a dime here. Now, coming up on Bloomberg Technology, Trust Machines will join BTech next with Caroline Hyde, but that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.